Right, thanks, Ashley. Well, first of all, did you see the haircut that I had in that picture that you put up? Those were the days that you could actually go see the barber and get your hair done. But the good news is, fear not, I'm going to be able to get a haircut this Thursday. So, really important. Okay. And so it won't be such a mop up there. So, anyways, thanks for having us here. We've been in business for the last 11 years, and we'll just kind of give you a brief overview of all that. But I will start by just giving you just a little bit of background on myself. I was born and raised here in Reno. I have four kids. They range from anywhere from 21 to 28. And then I've been married to my wife now for a big 32 years. So it's been a great ride. And there we go. There's a little picture of the family. My oldest son is married, and he is in the Air Force, and he is stationed in Japan. And so that's a little picture of the whole family. We went to visit them this last summer, and it was a lot of fun in there to go see those guys. And then the other person there, which is on the far right, is my daughter's boyfriend, longtime boyfriend, and probably will be future husband. I won't say anything else on that, okay, on the deal. But there you go. That's kind of the family. Like I said, I was born and raised here in Reno. Been here for the last 54 years. We've got a great family. My mom moved out here where she had three siblings, and all those siblings had two kids. So I have lots of cousins out here, and uncles and aunts and all that other good stuff. So this is where we hang out. So what are we doing for a business? We're here in Reno, and yet we buy all these homes in the Midwest, and that's what we do. So we buy homes that are in Cleveland, St. Louis, and Birmingham. Those are our three main cities. We're adding in now Toledo and Akron, Ohio, as well. We buy homes that range in the range or about $75,000 to $100,000, and we buy them, we rehab them, and then we put a tenant in them. And it's all about a buy and a hold. So there are a few ways that we'll talk about here on the ways that you can actually invest in here or with us. But the reason why we buy these homes in the Midwest is because they don't fluctuate a lot up and down in value. So it's not a huge timing of the market that we have to worry about, whether the market's going up or the market's going down. They have very good rent ratios. So we have a very good yield on each one of these homes. And that's why we stay within what we call the affordable housing range of everything there. This is the area that gives us a lot of safety. So not only do we add safety to the portfolio by being in many geographical different areas, even within the cities themselves, right? We're not all in just one neighborhood or two streets or something like that. But we add it in there by having affordable homes. Because anytime something happens within the economy, like partly what we're dealing with now, people don't upsize when things go badly, they downsize. And these are the most affordable homes that you can be in to rent. You can probably find more affordable if you really want to work at it. But this is the core rental market with that. As of today, we have about, it's probably around 740 doors that we have within the portfolio. And we keep growing that at about 50 or so homes per month. And we will continue to do that. So that gives you sort of an overall basis of what we do. And I know we're going to talk a little bit about how we can invest and do a few things like that. So I'll throw it back at you, Ashley. I'll put some pressure on you. Maybe you'll come up with a perfect question.
Sure. I mean, I guess that's what I'm here for. So
Right.
I will take that. So the topic for today is recession-resistant investment options. And Hughes Capital offers more than one option for recession-resistant investing. Can you give us an overview of those two options and where they differ or share similarities?
Sure. So there's really two ways that you can come in and invest with us. So the first one is we run a fund. And so the fund uh, holds X amount of homes within it, okay, and you put your investment into that fund, your investment represents a pro rata share of that fund. So at the end of each month, you get your pro rata share of the net profits. At the end of the year, you actually get your share of the depreciation on all the homes. But you're part of the fund, so you don't have any specific properties that you own out of that. It's a very easy way to do it with your IRA, with a 401k, and or just cash to come in. Right now, the fund is returning 8.6%. Plus, you're going to get about another 1.5% on the depreciation side of that. And so that's one way to come in. The second way to come in is what we'll build you a custom portfolio, and we call you a secured investor. Now, the reason we call you a secured investor is because when you come in this way, we actually are going to sell you a home and put your name on the title of that home, or homes. Most of the time, it's homes. And so when we sell you that home, your name goes on the title, but yet we do something very different than most anybody else that's out there. And what we do is we actually lease that property back from you, and we take on all the responsibilities, and we take on all the performance issues of that piece of property, and we turn around and just pay you a set monthly income. So the advantage there is that you do have your name on the title of the property. You do have some additional security because of that, you know. And then one other, so there's really maybe two, I guess we really need to cover, is as a secured investor, when we do such a thing, you are able to actually go out and finance those properties and increase your return. So let's talk about if you did it all cash. If you did it all cash, you're going to be somewhere between about 7 to 8% returns for that. Again, that's going to be paid to you in a set monthly income. And it becomes our responsibility for everything that happens with that house, which we'll talk about here in 2 seconds. And then the other way is if you finance it, you can most of the time almost double, if not double, that return by doing that financing. So what I really want to point out and make very, very clear is if you come in and we do a custom portfolio for you, those homes, even though they have your name on the title, end up going back into our portfolio. And so it's, again, diversified on all that. We look at it as we're managing that whole portfolio, say 740 doors. It's not about the 10 homes that maybe you bought from us. Because what we're going to do is it doesn't matter whether that house needs a new hot water heater, we're going to go fix it and pay for it. Doesn't matter if it needs a new roof or any of that sort of stuff. We're going to take care of that. Doesn't matter if the home is vacant. We're going to set up where we pay you a set monthly income for that side of the investment. And so that is just another way to come in. We have now a lot of people that like to do 1031 exchanges, and that's a really big deal for the way that we've set this up. And that we do it in the custom portfolio as well. So we do it to where your name goes on title, and that meets the 1031 exchange requirements. And then all the same stuff happens. We lease that property back from you. We become completely responsible for it. One thing I have not said is that you are responsible for one single thing, and that is the owner's insurance. So the expense of the owner insurance is yours as the owner. And even with that, we'll help you to get it set up. We'll even pay it for you. It just is an expense out of your pocket on that deal. So that's covering some of what you said, Ashley. Now, you did kind of ask, why are these recession proof from that standpoint? So I guess big, long answer here is a little bit of what I talked about before. We're very recession proof, proof or resistant, whatever you want to call it, because of what we buy. And it's buying those homes in the Midwest. They don't go up and down in value a ton. We will get appreciation over time, but it's small. It's mainly a cash flow play. And then you add to that, we have such diversity. Think about it. If you bought 3 houses, you have 3 rental houses, right? One of them goes empty, is vacant. Well, all of a sudden, 1/3 of your income is gone. for whatever period of time that may be. In our case, it's not, it's based on that entire portfolio. So even though your name is on those homes, you're still diversified within our whole portfolio because that's the way we turn around and pay you the set monthly income. I'll finish this up with one last bit because the other piece of all of this is people always want to say, how do I get my money back out, right? Because if you're in the fund, it's just a 90-day notice. Give us a 90-day notice and you can redeem your dollars back out. Most of the time we can do that even in less than 90 days, but it depends on timing and dollar amount. If you own the properties where your name's on the title, we'll buy those properties back from you at the original price that we sold them to you for. So it puts you in a very good, strong position. It puts you in 100% passive investment to where you never have to mess with any of that stuff. And all the responsibility and performance issues fall back on us. Is that a long enough answer?
I think that was a great answer. I mean, it's
All right.
it's kind of a big question, right? So
Yeah.
that seemed like an appropriate answer for that kind of question. I think it's a good time to open it up for some other questions, if that
Okay.
sounds good. So like we mentioned earlier, you can submit questions to us by using the Q&A tool at the bottom of the screen. I noticed that a couple people popped in after we had gotten started, and I just wanted to let you know that we'll be sending you all a full recording of this webinar. So if you missed anything at the beginning, you'll have a recording that you can watch later. So feel free to start sending us your questions. They just go to us. No one else will see them. And I do have a couple here already for you. Let's see. This one we get a lot, which I can say because I have seen many Greg presentations over the years, and this comes up every time. But who manages the properties?
Yeah, this is really important. It's important to the success of what we do. So when we hit about 300 homes, we started to put our own people on the ground. So we stopped relying on any third-party property managers. And probably people that are on this webinar tonight, most likely they've all had some type of rental properties. They probably have dealt with property managers, so they're going to know exactly what I'm talking about here. It's always a challenge when you're working with third-party property managers. And so once we hit what we call the economies of scale with that, we are able to put our own people on the ground. And so right now in the Midwest, we have probably 15 to 18 people that are full-time employees that work for us. And so that includes, we have real estate brokerages that are there. We have property managers that are there. We have construction managers that are there because we have almost every one of these homes that we buy, we rehab and bring it up to a nice standard. And so what that does is it gives us a lot of control. It really is night and day from when we had to use third-party property managers and others to help us out there. Total employees, we have about 50, 55 or so. So the rest of them are all here in Reno. They work with all of our people on the ground there, but having those people on the ground taking care of those places, that's why as we add Toledo and as we add Akron in, the only way we do that is when we have our own people on the ground that can help to do all of that. Otherwise, we won't buy in those areas at all. So yeah, that's really important.
All right, I have another question here for you. How does leveraging work?
Well, if you were to buy a piece of property and let's say you made 8% on the property, and then but yet you could go out and you could buy two pieces of property in this example, still be 8% if you bought them all cash, but instead you borrowed part of that money. Then if you can get the money for less than the 8%, which you can today, just talking to the mortgage broker today that we use to help people get financing. Mortgages are right now running between about 3.9 to about 4.1%. So what happens is if you can get that money and use part of that money to buy those properties, you can increase that 8% return. And so depending on how it all pans out and everything that you're doing, that's why we see anywhere from, if you're making 8% all cash, you can easily make 12%, 16, 17%, depending again on how all that falls out. But that's a way, and real estate is the number one probably asset that's out there that you can really leverage and do it very safely too, right? Because there's smart debt and there's dumb debt. Dumb debt is when you buy stuff, that doesn't make you any money, right? I mean, you buy the boat, you buy the RV or whatever. It's not dumb to buy that, but if you're using debt for that, it can get you in a lot of trouble. Very smart debt is when you buy something that makes you money, such as real estate. So for the most part, unless you've leveraged it really heavy or you did a bad buy, you're going to be in pretty good shape. And that's again why we look at this stuff 100% from cash flow. We want to only own properties that can cash flow all day long. We could care less about any appreciation that happens. If it happens, it happens. But it doesn't affect us at all. And we're very long-term thinkers. This fund and running all this, we expect to be doing this 20, 30 years from today. This is not about buying the house and flipping it or doing any of that sort of stuff. We're not, I mean, we love it if people want to finance and make a big old return. That's great. And I think you can do that very safely. But for the most part, what we're the most interested in is a nice, consistent return that doesn't fluctuate much over time. So now you can get that by financing because it's the right product. That's what's most important about it.
So does Hughes help with the leveraging process, or does the investor have to do that themselves?
Well, we'll set you up with a mortgage broker. You can get up to 10 mortgages in your name. So say you have a mortgage on your home, that means you could get 9. We'd set it all up. We'd show you how we do that. We could put you in touch. Unfortunately, we can't do everything for you, or we would. So there's a little bit of a pain of going through to get the debt set up on those properties. It's just the normal stuff. Got to do tax returns and all that. But the beauty is when it's all done, you have an unbelievable mortgage that's a nice 30-year mortgage that is very, very affordable, that's going to help you to leverage those properties. So I always tell people, as long as you're willing to do that and that makes sense to you, that little bit of pain pays way off for you in the long run. So yeah, we'll do everything we can to help you get through that process.
So related to debt, and this is another question that's come up recently, but is it safe to take on debt right now? And could that become a problem during a recession?
Yeah, it goes back to my original kind of answer there, the smart debt, dumb debt. You're always fine as long as you're buying the right asset. If you buy the right asset, it's not even really debt. Um, you almost could think of it as buying a business, right? If I can use cheap money to buy something that makes me more money, then you're always in good shape. What you don't want to end up doing, and this is where debt can be the friend or foe, right? If you buy, let's go to Reno for a second. Let's pick on my hometown of Reno. If you go buy a house right now in Reno, you have almost zero chance of having any cash flow. So let's just call it that you break even. Okay, well, that's great until you run into a problem. And as soon as you run into a problem where, say, the property goes vacant for a period of time and you have debt on it, well, now you have a monthly mortgage payment, right? Now you have to come out of pocket, your own pocket, to pay for that. That's the dangerous situation that you can be in. Now, you might make great appreciation in Reno. You may not, too. That's the problem. It's speculation. We try to not speculate at all with what we do. We like the most stable, boring investment that we can find. And that is homes in the Midwest. And if we can do that, we love that all day long because we know, especially as we've built this and have all that safety net kind of underneath us from what we've done on geographically diversified and having a large portfolio, we don't really have to worry about if there is a downturn. We're not going to be losing tenants out of there. So, and even with the deal that's happening right now with COVID, it's only going to be a little bit of softening probably for a very temporary period of time. Other than that, people need a place to live. That's not going to change.
So we didn't really talk about compounding, but if someone wants to reinvest their monthly payment, can they do that instead of having it put into their account?
They can. So if you're in the fund, you can just make the choice. You can either take your income out as a dividend, basically, okay, or you can just reinvest it and just let it compound in there. If you own the properties and your name's on the title, and we're going to pay you that set monthly income, you can, instead of taking that on a monthly basis, which you can do, or you can take that and reinvest it and open up an account within the fund. And that would then reinvest and you'd make money on that account in the fund.
All right. I think we have time for one more question before we wrap up.
Okay.
But how quickly does an investor get paid after putting their money in?
If you go into the fund, you get paid right off the bat. There's a pro rata amount that we pay you. So say you go in on the 10th of the month and there's 30 days, you're going to get paid for those 20, 21 days in that. So you get paid right away. If your name is on the title and you're buying the pieces of property, then you're going to get the same thing. We're going to pay you the pro rata amount for the rent. And then you're going to get, and then rent is actually just like everything else, that set monthly income, right, is paid at the beginning of the month for that. So after that, once you're in the fund, it's on the 10th of the following month each month.
And actually, we do have another question
Okay.
here. When I'm ready to sell the properties, how does that work?
All right. So you own the properties, and the way that we work this is inside of the set monthly income, we include a part of the appreciation. So we make an estimate. We look to see how much appreciation is with going to be within those homes. Okay. And what we do is we include about half of the appreciation. So we basically prepay you the appreciation on those homes. Now, in return, what we want to be able to do, and this is also another protection for the investor, is we want to be able to buy that property back from you. But we get first right of refusal to do that, and we get to do that at the original price because we've already prepaid some of that appreciation. So let's just say that we look at a city and the appreciation over the last 20 years has been 2%. You might be getting paid somewhere between 0.5% to 1% on that upfront. And then we're going to get a little bit of that on the back end. But we've also taken the risk from that perspective. Now, the other side of that is because these properties don't mean anything from you from an individual standpoint, because it goes back into the whole portfolio, we're also willing to buy those homes back at the original price, even if you ended up having a bad property. Let's just say, and by the way, we know all of our properties. So anytime you buy a property from us, we've already bought it, rehabbed it, and put a tenant in it. So we're plenty good with anything that we're going to sell you and then take back and lease it back from you. But you never know, something changed or whatever. If that property ended up being not such a great property, it doesn't matter. We will still buy that property back at the original price. So it gives a protection all the way around. I know sometimes people say, well, I want my real estate to help me to produce, appreciation. But this is not the right real estate for this. This is a cash flow real estate. This is a real estate that's not going to go up a ton in value. But then we're not having to gamble. We know what we're getting. We're going to get a very consistent return. And you can see that with what we've already done so far.
All right. Well, we are getting close to the half-hour mark. So I know we don't always get to everyone's questions, but in a few minutes, we'll show some contact information for us for how to get in touch with our team. But Greg, did you have any final thoughts that you wanted to share?
I think we covered most of it. It's the same old stuff. I know that when people come on here, maybe it's their first exposure to hear what we do. Hopefully it all makes, reasonable sense, but we just encourage you to give us a phone call or email us or whatever. We can set up a time. We can do a face-to-face meeting if you feel comfortable doing that. We can do a Zoom call like this so we can face-to-face on the computer screen, or we can just do a phone call. Whatever works. It doesn't really matter. We love to do the face-to-face if we can. And of course, that's been a little bit on the strange side lately, but we are now starting to see people back in the office and going through some of that stuff. So I know you're going to give them the contact information. And we'd be glad to answer any of those questions. I know a lot of times when people are looking to do a 1031 exchange, that can be a little bit more complicated if they haven't been through it. But again, we can make it very easy for them and basically handhold them through the. Our job is to make it as easy as possible for everybody that invests with us. So other than that, thanks, Ashley, and thanks everybody for coming tonight.
Real quick, we did get one more question
Okay.
for the end, if you're game for one more
Uh-oh.
question.
Is this the Columbo question?
No, it's, I think, a
Okay.
perfectly reasonable question. It just came in as we were starting to close, and I wanted to make sure we were able to address it. So the question asker asks, what is a typical reasonable LTV percentage on a guaranteed master leased finance property that still shows a decent return? I can post that. I can send that to you in text if that's easier, because I think I just said it really quickly. I can repeat it though. What is a typical reasonable LTV, which I'm assuming means loan to value ratio? Okay.
Yeah.
On a guaranteed master leased financed property that still shows a decent return.
Okay. So we're getting technical here, right? And this is a little bit of, I don't want to say dangerous territory, but because every deal is going to be a little bit different, I will tell you that when we figure out the projected net returns for the custom portfolios, we use a 67% loan to value. Okay, so that means you've got to put 33% down as a down payment, and you're going to get a loan for 67% of whatever you're buying in all. That works very well. We know that's very conservative. You can take it up to an 80% on the mortgages. But, and there's nothing wrong with that. That's fine. But you just have to kind of work through that process. It just really depends on what we're doing and whether it's a 1031 exchange or people are just coming in with cash and a down payment. How many mortgages can you do, et cetera, et cetera. So we work that out. We always, obviously try to work it out to the benefit of the investors so they can get the best return. So hopefully that's answering that question.
Yeah, thank you for answering that.
Okay.
And I mean, that's kind of a good time to note that if you have more questions like this, sometimes they are better suited to one-on-one calls with our team. So when we actually wrap up now, I will show the screen that has our contact information, and you can submit your preferred contact information through the Q&A if you prefer email or phone number. And again, that just goes to our team, and we'll reach out and follow up with you and set up a call so we can answer some of those questions.
All right. Thanks everybody for coming.
Thanks, Greg. And I'm going to put up that screen in just a minute, but thanks for everyone for joining us. And we hope that you got most of your questions answered. And like I mentioned before, we are going to send you a recording of this webinar so that you can reference anything that we've discussed. And we look forward to hopefully meeting you soon.